Here's a company that quietly put $4.51 billion in revenue on the board last quarter. That's billion with a B, in a business that essentially sells human beings to other businesses. And I mean that in the most boring, profitable, brilliant way possible.
ManpowerGroup, one of the world's largest staffing companies, 75 countries, roughly 2,200 offices, and right now, trading at less than 8 cents per dollar of annual revenue.
I'm Hudson Thomas. Welcome to Charged Alpha, the S&P 500 stock encyclopedia. Today we're going deep on ManpowerGroup Inc., fresh off Q1 2026 earnings reported yesterday, April 16th, and there's a lot to unpack.
They beat estimates on both revenue and adjusted earnings per share, but they also showed the street a forward guidance range that landed a few cents below consensus. So of course the analyst community did what it always does, they cut their price targets.
The eternal paradox of beating today while getting punished for tomorrow. All right, Lana, let's build this one out from the ground up. So let's set the stage. ManpowerGroup was incorporated in 1948, that is not a typo, in Milwaukee, Wisconsin, 78 years in the business of connecting workers to work. You don't build 2,200 offices across 75 countries by being bad at this.
The company runs 4 main brands. Manpower handles the bulk of temporary and permanent staffing for administrative and industrial workers. Experis focuses on professional talent, IT, finance, engineering, where margins are better. Talent Solutions handles large-scale workforce outsourcing and recruitment process outsourcing, and ManpowerGroup Solutions wraps it all together for enterprise clients.
So it's not just a temp agency, it's a full-service human capital business. About 26,700 full-time employees running this machine, and they placed millions of workers into jobs last year across dozens of labor markets.
The revenue mix is geographically diversified, which cuts both ways. Southern Europe is their largest segment. France is a massive market, and it showed 14.6% reported growth in Q1 2026. The Americas and Asia-Pacific segments also contributed positive growth.
What's the moat here, though? Because staffing sounds like a commodity business.
Scale and regulatory expertise are the real moats. When you want to hire 500 warehouse workers in France or 200 engineers in Japan, you need someone who knows local labor law, has the candidate pipelines, and can turn the hire on quickly. ManpowerGroup has built that infrastructure over decades. Replicating it from scratch is enormously expensive.
And they're layering AI on top of it now. Their PowerSuite platform, which covers nearly 90% of global operations, is starting to generate what they call incremental revenue in Europe. Not transformational yet, but it's early.
The Experis brand is also where you get the premium. Specialized tech and finance talent commands higher bill rates and better margins than commodity staffing. That's a strategic piece of the portfolio.
Let's talk about the person running this show. Jonas Priesing has been CEO since 2014, so we're 12 years into his tenure. He became chairman the year after. This guy is a lifer. He joined ManpowerGroup in the late 1990s after a decade at Electrolux running Asia-Pacific operations and global B2B sales.
He speaks 5 languages: Swedish, English, French, German, and Italian. For a company operating in 75 countries, that's not a trivial detail. It signals genuine global fluency, not just a passport stamp collection.
His ascent at ManpowerGroup was steady. He ran the Americas and Southern Europe as president before stepping into the CEO seat. And on the analyst side, he's viewed as an operational disciplinarian with a credible focus on digital transformation.
He was just elected to the Federal Reserve Bank of Chicago's board in January 2026. That's not a title you pick up at random. It signals credibility in the broader business and economic community. And on the Q1 call, he was emphatic about the AI transformation underway. Nearly 90% of global operations now running on PowerSuite, with early revenue results coming in from France.
The knock on staffing CEOs is always that they're riding macro cycles rather than creating value. Prising's answer to that criticism has been this structural cost savings program, $200 million in permanent savings by 2028, which aims to make the margin profile less dependent on volume. All right, let's dig into the financials. Lana, take us through it.
Starting with the headline. Q1 2026 revenue came in at $4.51 billion, up 10.3% year-over-year versus Q1 2025. That blew past the consensus estimate of $4.41 billion. Organic constant currency growth was more modest at 3%, but reported growth benefited from favorable foreign exchange tailwinds.
So the headline looks better than the underlying growth. That's an important nuance.
Exactly. On the adjusted earnings side, ManpowerGroup reported 51 cents per diluted share versus the 50-cent estimate. A penny beat. On a GAAP basis, the number was just 5 cents because they took $26 million in restructuring charges related to that transformation program.
Those restructuring charges are real cash leaving the building, but they're also front-loading pain to create future savings. It's a bet, but it's a structured one.
On valuation, the stock is trading at some historically extreme discount metrics. Price to sales on a trailing 12-month basis is roughly 0.08 times. That's 8 cents per dollar of revenue. Price to book is 0.71 times, meaning you're buying the assets below what they'd cost to liquidate on paper. And the forward price to earnings multiple based on full year 2026 estimates of around 3.62 is roughly 8.7 times.
Those are value investor numbers for a company with 75 countries worth of infrastructure.
Now, the important caveat. Trailing 12-month margins tell a more complicated story. Gross margin is running at 16.5%. That's the take rate on revenue after paying workers. Operating margin is razor thin at 0.82% TTM, and net margin is technically negative on a trailing basis due to that large Q2 2025 loss from restructuring.
What happened in Q2 2025?
$67 million in net losses, driven by restructuring charges and write-downs in that quarter. Strip those out, and the underlying earnings power is positive, as the Q3 and Q4 2025 results showed, 38 cents and 64 cents adjusted EPS, respectively.
So the trailing numbers are distorted. The forward picture is the more informative frame.
On cash flow, and this is the most important near-term watch point, trailing 12-month operating cash flow is negative at roughly minus $77 million, and free cash flow is minus $130 million. Q1 2026 operating cash flow was minus $126 million, which is typical seasonality for staffing. Receivables build in Q1 as activity picks up.
But that's still negative, and they're paying a dividend.
Right? Annual dividend is $1.44 per share. That's a 4.6% yield at current prices. With negative free cash flow trailing, the dividend is technically being financed by the balance sheet right now. Cash on hand is $225 million. Total debt is $1.4 billion, net debt of $1.31 billion.
How does that balance sheet stack up?
Current ratio is 1.12, barely above 1. It's not alarming, but there's limited cushion. The saving grace is that staffing businesses are capital light in operating terms. The heavy lifting is accounts receivable. They pay workers before clients pay them, and the receivable book was $4.6 billion at quarter end. Overall, ManpowerGroup's financial health is watchful. The company is executing a meaningful transformation program against razor-thin margins and currently negative free cash flow, but a 4.6% dividend yield, a 0.71 times book value, and 8.7 times forward earnings price in substantial pessimism for a global workforce leader with 75-country reach.
What does Wall Street make of all this?
The consensus rating is hold. 6 analysts covered in our data, 1 outperform, that's Baird, 4 neutral to hold ratings, and 1 effectively negative. Average price target is around $35.50 against a current price just under $31.40. Implied upside of about 13%.
Baird is the lonely bull here.
They reiterated outperform after Q1 earnings, but cut the target from $50 all the way to $45. Goldman Sachs actually upgraded ManpowerGroup from sell to neutral in March 2026. The most bearish major analyst on the stock finally threw in the towel. Truist maintained hold, but cut from $38 to $34. Barclays cut from $35 to $30.
The pattern is consistent. They beat on Q1, but the Q2 guidance spooked everyone.
Q2 guidance was EPS of 91 cents to $1.10, including a nickel of foreign exchange benefit. Consensus was expecting about 96 cents. It wasn't a disaster, but it wasn't the clean beat and raise that bulls wanted. Revenue guidance was 1 to 5% organic constant currency growth, midpoint 3%.
Last quarter, Q1 2026, adjusted EPS was 51 versus 50 cents estimated. Revenue of $4.51 billion versus $4.41 billion expected. Those are solid beats. Q4 2025 was also a beat, 92 cents adjusted versus 83 cent estimated, and revenue of $4.71 billion against $4.62 billion. So there's a clear pattern of beating on execution. The question the street is asking is whether that trend holds. Okay, let's run the tape from both sides. Lana, you're the bear, I'll take the bull. We'll keep it fair.
Always.
The bull case starts with valuation. ManpowerGroup is trading at 0.71 times book value. You are paying less than the accounting value of the assets. At 0.08 times price to sales, the lowest in the peer group by a mile, the market is pricing in near-permanent margin compression. If they execute even half of this transformation program, the margin trajectory improves meaningfully, and this stock re-rates.
And the 4.6% dividend yield? You're getting paid to wait.
Exactly. The transformation program targets $200 million in permanent annual savings by 2028. They're expecting $40 million already in 2026. AI-powered tools on the PowerSuite platform are showing early revenue traction in France. Southern Europe delivered 14.6% reported revenue growth in Q1. Goldman Sachs, historically the most bearish major voice on this stock, just upgraded. These are all tailwinds converging.
I'll take the other side. The AI risk to staffing is not a theoretical concern. Automation and artificial intelligence are structurally reducing demand for the kinds of temporary workers ManpowerGroup places: administrative roles, basic industrial jobs, lower-skill white-collar positions. This is a business where the ceiling may be lower 10 years from now than it is today.
That's a fair point.
And the free cash flow situation is real. Negative $130 million in trailing free cash flow while paying out a $1.44 annual dividend. That's roughly $67 to $68 million per year to shareholders. That math only works if FCF turns positive again soon. If margins don't recover fast enough, dividend sustainability becomes a live conversation. And Q2 guidance missed consensus. That's not a great signal for near-term demand.
So the bull thesis requires a recovery in FCF, margin execution on the transformation plan, and patience. The bear thesis says the structural forces are working against you, and the guidance signals don't inspire confidence. Both are reasonable reads on the same data. How does ManpowerGroup stack up against the rest of the staffing sector?
The peer group tells a story of divergence. Robert Half International, ticker RHI, is the best-known U.S. comparator. They're running a price-to-sales multiple around 0.38 times, nearly 5 times ManpowerGroup's multiple. But Robert Half is actually seeing revenue decline, down roughly 5.8%, as demand for their core temporary office worker placement business weakens in North America.
So higher multiple, worse growth. That's interesting.
Heidrick & Struggles, ticker HSII, is the outlier on the upside. They specialize in executive search and leadership consulting. They're showing 15.9% revenue growth and command a PS around 0.25 times. But they're a much smaller, more specialized business, not a direct comp.
What about Insperity?
Insperity, ticker NSP, focuses on HR outsourcing for small and mid-sized businesses. PS around 0.22 times, revenue growth of 3.4%. That's actually similar organic growth to ManpowerGroup, but Insperity gets a higher multiple because their model is less cyclically exposed.
So ManpowerGroup is getting the lowest multiple in the group by a significant margin, despite being the largest by revenue and having the broadest global footprint. That's the valuation dislocation the bulls are pointing to.
It reflects the market pricing in ongoing margin pressure and AI disruption risk more severely for ManpowerGroup than for its peers. Whether that's correct or overly pessimistic is the central question.
Let's check in on the options market. What are traders saying with their money?
The put-call ratio is running around 0.82. That's modestly bullish. Less than 1 means more call activity than put activity. Implied volatility is sitting at roughly the 52nd percentile, elevated relative to ManpowerGroup's historical average, but not in panic territory.
So the options market isn't screaming fear.
No. The largest open interest cluster is at the $35 call strike, which aligns closely with the Analyst Consensus price target. Put protection is stacked at $30 and $28, consistent with where Barclays and Goldman have their floor targets. That's traders hedging against the analyst downside scenario, not betting on catastrophic outcomes.
As always, options activity reflects positioning and sentiment, not prediction. Keep that in context. What about insider activity? What are the executives and large shareholders doing?
No significant C-suite insider transactions in early 2026, which is notable in itself, neither strongly bullish nor alarming. On the institutional side, 163 institutions added to their positions in Q1 2026 versus 153 that reduced. Slight net positive. Goldman Sachs's institutional asset management arm raised its stake by 12.5%, adding nearly 39,000 shares. UBS Asset Management added 9.4% to its position. So the same firms upgrading or holding ratings are also quietly adding to positions. That's worth noting.
No red flags, no dramatic insider selling. For a stock trading near multi-year lows, the lack of insider exits is actually a modest positive signal. Before we wrap up, let's crystallize the key risks and forward indicators.
The structural risk is first. AI and automation reducing demand for temporary workers is not a cycle, it's a trend. ManpowerGroup's ability to pivot into higher value professional staffing through Experis and to monetize AI through PowerSuite is the strategic answer, but execution matters enormously.
Free cash flow is the tactical risk. The $1.44 annual dividend requires positive FCF to be self-sustaining. If the transformation program delivers its savings on schedule, FCF should turn positive in the second half of 2026. If it doesn't, dividend sustainability becomes a market focus point that could pressure the stock further.
The Q2 guidance range of $91 to $1.10 is the near-term litmus test. Hitting the high end or surprising on the upside would reframe the narrative sharply. Landing near the low end would validate the bears.
Watch European organic growth. Southern Europe was the bright spot at 14.6% reported growth. If that segment starts showing organic deceleration, the bull case gets harder to make. And watch for any commentary on AI tools actually generating revenue, not just deployment. All right, let's bring it all together. ManpowerGroup is a 78-year-old global workforce solutions giant, trading at genuinely value-tier multiples. It beat Q1 2026 estimates on both revenue and adjusted earnings. It's executing a structured transformation program targeting $200 million in permanent savings. And the stock offers a 4.6% dividend yield while you wait for the re-rating thesis to play out.
The caution flags are real. Negative trailing free cash flow, razor-thin operating margins, a slightly disappointing Q2 guidance, and a structural question mark around whether AI reduces the long-term ceiling on the business. This is not a buy-it-and-forget-it situation.
The key metric to watch is gross profit margin trajectory and free cash flow conversion over the next 2 quarters. If the savings program delivers and FCF turns positive by Q3 2026, the dividend is safe and the valuation re-rating thesis becomes significantly more compelling. I want to close today with something that feels right for a company in the middle of a transformation.
Go ahead.
Charles Darwin. It is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change.
For a company that has been placing workers into jobs since 1948 and is now deploying AI at global scale to reinvent how it does that, that's an apt framing.
ManpowerGroup either adapts its model for the AI era, or Darwin's observation applies to them too. The next few quarters will tell us a lot about which outcome is more likely. That's going to do it for today's episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.